In this video, we're going to prepare a common size balance sheet, a common size income statement, a balance sheet scaled by sales, and then a trended income statement. Let's begin with our common size balance sheet. On a common size balance sheet, we take every single item on the balance sheet, beginning here with cash, and we divide it by total assets. Accounts receivable divided by total assets. Now, we can make our work a little bit faster if we anchor our cell reference. Since we're always coming back to total assets, which is in row 15, we can go into our formula and put a dollar sign in front of the 15. Now, I've got a formula that I can copy down. If I copy it down one cell, notice, now it's still B15. Copy it down again. It's still B15. So I've got a formula that I can copy all the way down. Since I didn't anchor the cell reference to the column, which would be column B, I actually have formulas that I can copy all the way across. So I can copy that completely across to years 1, 2, and 3. Notice if I go in here for other assets, it's taking other assets from above and dividing it by total assets. And of course, we can always go back in and add our formatting if we'd like. And then we can move down to the balance sheet or the asset or liability and equity section of our balance sheet as well. So we'll take our line of credit in year 1 of $61,119,000. And of course, we could divide it by total liabilities, shareholders' equity, or total assets since our balance sheet balances. And again, I want to anchor the reference to the row, and I anchor it with a dollar sign. And I've got a formula now that I can copy down and across. From our regular balance sheet, we can tell that the company has grown. Total assets increased from $132,000 to $363,000 in year 3. What we can't tell right off the bat is, has our cash as a percentage of assets increased? How about inventory as a percentage of assets? Has it increased? We can get that information from our common size balance sheet. We can tell here, cash in year 1, 13% of our assets were in cash. By year 3, only 1% of our assets were in cash. In year 1, 50% of our assets were in the form of inventories. We had reduced that to 44% by year 3. In year 1, net plant and equipment accounted for 2.3% of our total assets. As a percentage of total assets, that has now grown to 6.49%. Back in year 1, liabilities, we only had current liabilities, accounted for 66%. That's how we finance our assets. 66 cents of every dollar was financed with debt. That has decreased to 43%. Our common stock has gone from 12 to 25%, and our retained earnings from 21% to 31%. So we can tell we issued new common stock and we've become more profitable. So that's the type of information we can get from our common size balance sheet. Our common size income statement takes every item on our income statement and scales it by total sales. So sales divided by sales. And again, we're always going to want to come back to row 6. So we're going to put the dollar sign in front of the 6. And I've got a formula that I can copy down and across. And of course, I can go back in and reinsert my formatting. Let's see what our common size income statement tells us. Back in year 1, we spent 57 cents of every dollar in sales to generate that sales in terms of on merchandise or cost of goods sold. That had increased to 65 cents on the dollar by year 3. So our gross profit, or the amount of money we're making before we cover our operating expenses, has gone down over the past 3 years. Overall, our profit has gone down as well. We were generating 9.85 cents for every dollar in sales, roughly 10 cents. That's dropped to 3 cents. In our common size income statement, we can easily identify why. And we can see cost of goods sold has gone up from 57 to 65 cents on the dollar. Depreciation expense has gone up Selling administrative expenses have gone up, as has interest expense. Our costs are going up all the way across the board. The one bright spot is a slight decrease in our tax expense as a percentage of sales. But that's nothing to get too excited about. That's really simply because we have become less profitable. We were earning 16 cents in profit before taxes. Now we're only earning 5.69 cents in profit for every dollar in sales. And so we would expect to spend less in taxes. Let's go back to our balance sheet tab. We are also going to create a balance sheet scaled by sales. This is sort of the reciprocal of our asset turnover ratios. We're going to take every single item on our balance sheet, cash, and divide it by sales in that year one. There we have it, the 223,000. And again, I'm always going to want to come back to that row. So I'm going to anchor that with a dollar sign. And I've got a formula that I can copy down as well as across. And of course, I can go back in and reinsert my formatting if I'm so inclined to do so. What exactly is this telling us? Back in year one, we had 59 cents in assets to generate $1 in sales. In year two, we were generating $1 in sales with 43 cents in assets. In year three, it's only taking 40 cents in assets to generate $1 in sales. So we can see we've become more efficient at generating sales with our assets. The biggest area of improvement is probably with respect to inventory. Before we had 30 cents in inventory for every dollar we generated in sales. We've dropped that to 17 cents. Our receivables, we used to have 22 cents in uncollected receivables for every dollar in sales. We've dropped that to 17%. So these are where we're going to see improvements in our turnover ratios for total asset turnover, accounts receivable turnover, inventory turnover. So this is just another way of looking at or measuring turnover. And of course, we'll do the same calculations with our liabilities and equity. We take the balance sheet item for year one, line of credit, divide it by total sales in year one. And again, we are anchoring that with the dollar sign in front of the 6 because we're always wanting to come back to row 6. And again, I've got a formula that I can copy down and across. The last thing we're going to take a look at is our trended income statement. We've already saw that our sales had increased from 223,000 in year one to 902,000 in year three. So sales have gone up, but overall our profits, while they went up, sales more than tripled, but our profit has not tripled. And we saw that in our common size income statement. And we identified why. We said, oh, well, that's cost of goods sold, depreciation expense, selling, and interest. Well, we might want to see how much these have gone up on a year-to-year basis. And that's what we find out on our trended income statement. So we're going to take sales in year two, 617,000, divided by sales in year one. And again, we are going to want to anchor the cell reference. In this case, we're going to want to anchor it for both the column and the row. So we're going to put a dollar sign in front of the B, because that way we'll always come back to year one as our base year. A dollar sign in front of the 6 will always be going back to we don't want the dollar sign that time because we're going to want to trend each item separately. So again, we're always going to want to come back to year one. So there we go. Oh, one last thing we have to do. Year two is 275% of year one. How much more did it increase? We just subtract 1 from that value. So sales went up by 175% in year one. From year one to year three, sales had grown by 300%. How does that translate to cost of goods sold? Cost of goods sold went up about the same proportion as sales in year one, but over that 3-year period, cost of goods sold has gone up by 358%, while sales only tripled. And we can see that, yeah, cost of goods sold went up more than sales, and our gross profit margin decreased over that 3-year period. So we can get that same information, we can copy that on down, and then we can look at our overall trends on our income statement. Let's start with our evaluation of our profit margin. We saw our profit margin went from 9.8 to 3.4%. In other words, we were making 9 or 10 cents on every dollar in sales we made in profit. Now it's gone down to 3. And we can see that because sales tripled, but our net income only went up by 42%. Our cost of goods sold, again, sales tripled, but cost of goods sold went up by 358%, faster than sales. Depreciation expense went up faster than sales. Selling administrative expense went up faster than sales. And of course, if those costs are going up faster than sales, that means our operating profit is going down slower or less than sales. So that's how we create our trended income statement. And we can either use a base year trend where everything gets trended and based on what happened in year 1, or other ways you'll see it is just a year-over-year trend. In other words, year 2 would be divided by year 1, year 3 would be divided by year 2.